Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. I hope that all of you are doing well and are excited about 2018 just as much as I am today. We've been talking quite a bit regarding all the different changes in 2018 to our tax laws and so forth. And last week we did do a webinar, and we also did a podcast on the fallacies of 401ks and the fact that, for some people, they may work okay, but for the vast majority of Americans, 401ks are a horrible retirement distribution plan because of all the different issues and concerns and liabilities and inabilities to do exactly what you want to do with your money at the time that you want to implement your distribution technique. Today I'm going to take it in a different direction. Now, obviously, still going to be dealing with the issues of retirement planning, but I want to start talking about some of the things that we pay attention to when we work with our clients in reference to retirement distribution planning. Now, obviously, the more time that we have available to work with our clients, the better off we would all be, because it gives us the ability to put together and design a strategic distribution plan, but many a times you have to start years in advance. If I have anywhere between 7 and 10 years to work with a client, obviously I can accomplish a lot more from a distribution perspective than if I only have a year to work with a client, or perhaps even 2 years. Our goal at Cambridge, as you all very well know, is to make certain that we can reduce and or eliminate the tax liabilities for our clients in retirement. In other words, we do a weekly webinar that is called How to Divorce the IRS in Retirement and How to Do So Legally. So we will continue to discuss some of these issues as we go along. Now, one of the major retirement challenges that I see all the time in dealing with clients is that we have to understand the eroding factors. And I think the biggest challenge that we have in the marketplace is Americans know how to make money. They just don't understand economics. And the more understanding you have in economics, the better off you're going to be. Now, when we're talking about eroding factors, what are we talking about? Well, we're talking about those factors in the economy, factors that you might be able to control, but then there are other factors that you really have no control over. But these are factors that will negatively impact your retirement success, your retirement planning, and your retirement distribution in the future. And there are pretty much 10 of them that I address with each and every one of my clients when we engage them in the retirement planning process. Number one is taxes. Obviously, taxes, there's a very high probability that taxes are going to be a lot higher in the future than they are today. So that's a concern for all of us. Yes, we have had some tax reductions under the Tax Cuts and Jobs Act of 2017. But on the individual side of the house, because of the fact that it was not tax reform and it was primarily a budget reconciliation act, all of these tax benefits are going to sunset. In other words, they're going to end 8 years from now. So January 1 of 2025, unless Congress decides to extend those tax benefits, everything will go back to the way it used to be in 2017. The second eroding factor is inflation. Inflation to me is a silent killer, because by the time you figure it out, by the time you see it, it's way too late. It's just like having a heart attack. It just doesn't tell you when it's coming. It just happens. We have to be able to understand inflation fully. Now, inflation, number one, is not tax deductible. And there's also the inflation rate that is given to Americans by the government. And then each and every one of us also has a personal inflation rate. The more luxury we want in our lives, the higher the personal inflation rate is going to be. So you need to be able to understand that in retirement as well. Another eroding factor is loan and interest charges. Loans and the interest charges that you pay erode your assets. It erodes your ability to take that portion of those loan interest and reinvest them in an adequate way in order to maximize your internal rate of return. Financial expenses, there are many of them, and there are many fees and expenses that you pay. Now, some of them you have no choice, but I think it's critical to understand that you need to know which ones they are, so that way you can make an intelligent decision as to how you're going to proceed through your retirement years. Loss opportunity costs. This is one that the vast majority of financial advisors either don't understand or do not want to discuss with their clients. Every purchase, one of the things that I tell a lot of my personal clients is that everything in this country is financed, because I do get clients that tell me that they don't finance everything. They pay cash for everything that they acquire. To me, that's a form of financing. So if you really think about financing from an economics perspective, everything in this country is financed. Either you pay interest to someone else, or you fail to receive interest on your money by paying cash. Now, adequately, you have to be able to do a formula and a calculation depending on what it is that you're going to purchase, whether it makes more sense to pay cash or to finance. And the arbitrage or the opportunity cost is what we determine on behalf of our clients. But just bear in mind that everything is financed in our country. Number 6 eroding factor out of the 10 are stock market declines. And especially many of my clients have investments in the stock market, and the stock market is going to go north and south just about every day. Sometimes it goes north, for a couple of months. It could go north for a year or 2 years, and then it goes south for 2 or 3 years. The challenge with stock market volatility is you just don't know when it's going to happen. Even the experts do not have the ability to tell you that. Same thing happens with number 7, which is interest rate declines. I mean, many of my clients that retired in the early 90s, they were receiving 5 and 6% on a CD, so they would put their money in the bank and then live off the interest that those CDs would generate on their behalf. Today, you can't get that. So obviously, you need 3-4 times the amount of money that you had in 1990 because of the low interest rate environment that we're in order to generate the same amount of income that you could have back then. Number 8 is technological changes. We are an acquisition country. We're always acquiring new things. We're buying new toys. And technological changes are always there. Just think about the first time that you bought a cell phone, or when you had your beeper. And look at the type of cell phones that you purchased at that time. And then obviously as new features and benefits of technology come into place, we as Americans want to enjoy more and more of it. But you have to be careful. I have clients of mine that actually stand in line for hours when the new iPhone is about to come out. Obviously, I don't agree with that concept, but obviously they're my clients, so I try to, in many different ways, to save them from themselves. One of the things that I do share constantly here at Cambridge is that we do have the ability to help everyone, but we can't save everyone, and that's important to know. Number 9 is planned obsolescence. You're in retirement. Things are going to go bad. There's going to be wear and tear. You may have to replace your automobiles. You may have to replace different things in your home. You may have to replace a roof. You may have to replace furniture. You may have to replace refrigerators, stoves. There are a lot of things. So planned obsolescence also needs to be taken into consideration when planning for retirement. And then number 10, last but not least, is lawsuits. We do live in a litigious society, so it's critical to understand that many of us can get sued. So you have to make certain that your retirement assets are creditor protected in the United States, or at least in the state that you're going to live in, which is also very important. Now, there are many different ways, but there's one way to achieve financial security in retirement. And you have to think of retirement distribution planning about being a scientific process. It's not a product process. You know, whenever I talk to clients regarding retirement planning, they say, well, I have my 401k with Fidelity. Well, that's a vehicle. That's a product. That's not a retirement process. If you don't have a retirement process in mind, there's a very high probability that your retirement distribution planning is going to fail sooner than expected. Now, to that, I would like to add the Tiger Woods story, because although Tiger Woods is coming back and starting to play better after having, I don't know, maybe 4, 5, 6 back surgeries, when Tiger Woods was on top of the game, he would win just about every tournament that he set out to play. And one of the things that I try to create an analogy between the way that Tiger Woods used to play golf to retirement distribution planning is that, you know, if you're given the opportunity to play at the Masters and you, as an amateur, you know, want to play well and you want to have an opportunity to win that game, to win that tournament, and someone were to ask you, when Tiger Woods was on top of the world, would you rather have Tiger Woods swing, or would you rather have his clubs for the Masters? I would think that 99%, if not 100% of all of us on this podcast would have chosen to have Tiger Woods swing. Because at the end of the day, Tiger Woods could have played with any type of golf club and brand that he wanted to, and he would still have a very good opportunity to win that tournament. So retirement planning is the same thing. Retirement planning is not about a specific product, but it is about the swing. It is about a scientific process in which you start to bring different vehicles and the best of different parts of the world to your retirement distribution planning in order to make certain that you have a successful one for many years to come. Now, taxation, inflation, income guarantees are also paramount in achieving retirement success. And one of the questions that I always ask my clients is that in a perfect world, you know, what percentage of their income would they like to have taxed in retirement? If the answer is not zero, you shouldn't be listening to this podcast. Because in a perfect world, I would want to have a 0% marginal and effective tax rate. Now, again, one of the things that we try to talk to our clients about is, you know, how do you create a retirement distribution planning? And there are a number of vehicles that you can use in order to do so. One that is the most critical vehicle to have falls under the IRS code 7702, and I call that my Cambridge 7702 tax plan, and it involves life insurance. Life insurance has a tremendous strategic advantage in retirement because not only all of the things that it can accomplish, but because it is the one product under the IRS code that receives more tax benefits than anything else that is available under the code. Life insurance allows for the creation of retirement distribution straddles. See, if you don't have life insurance in a portfolio, the average 65-year-old couple is held hostage to an interest-only distribution model. You may think, well, what do you mean by that? Well, let me give you an example. Let's say that you have $1 million at time of retirement, and you're married, and you file your taxes, married filing jointly. And if you go based on the traditional distribution rates in the United States, if you are only withdrawing interest out of your account, then you may generate between $30,000 to $35,000 a year in income, gross of taxes. So $1 million portfolio in a conservative distribution rate will generate between $30,000 and $35,000 of gross income in retirement, and then obviously you will pay taxes on that amount of money based on your tax bracket. But if you have a proper executed 7702 insurance program in place, and let's say you have $1 million of life insurance, you see, in the first scenario, you had no choice to just live off the interest. Because if you start to dip into principal, not only will your principal go down year after year, but most important, the interest that you generate or the volume of interest that you generate will also go down, because now you have interest being earned on less and less principal. But if you have $1 million of life insurance, and you want to make certain that your surviving spouse is protected. See, the other issue with the first exercise is if you start dipping into principal while both you and your spouse are alive, what happens when you run out of principal and you're still alive? Or what if you pass away and now your surviving spouse, instead of having $1 million portfolio generating 3 to 3.5% of interest, now that $1 million portfolio is only half a million dollars, $500,000, and that's generating anywhere between $15,000 and $20,000. That's a big difference. That's almost a 50% drop. What if it's less than that? So the reason why people that do not have a tax 7702 plan in place can only withdraw interest is because they don't want to dip into principal, because A, they don't want to reduce their interest or the interest they receive annually, but most important, they want to make certain that in case of death or premature death, that the surviving spouse can continue to enjoy that income. But if you have $1 million of life insurance, now you have choices. Now you can create guaranteed straddles. Now you can do calculations where that $1 million, you can start to distribute not only interest, but also you can distribute principal. So instead of generating $30,000 to $35,000 of income per year, now you can guarantee a distribution between $75,000 and $80,000, sometimes $85,000 of income with the same $1 million. You see, retirement distribution planning is not about the accumulation rate. That's before retirement. When you get into retirement, the distribution rate, you have to make a paradigm shift. The rules of engagement totally change, and it is exclusively about the distribution rate. So if I can now distribute 8% out of that $1 million, as opposed to just living with my 3 to 3.5% of interest only, then my spouse and I will have a much, much better life. And then if at some point in time we either run out of money or I die and there's very little money left, then the insurance proceeds from the 7702 plan, which is received by the surviving spouse free from federal income taxes, now can replace that original $1 million that was used on a spend down way. So again, economic models capture the essence of various distribution efficiency rates and straddles, and those are the things that we specialize here at Cambridge. Retirement distribution planning is not something that you just put money away, and then when it comes to retirement, you have this pool of assets, and then what? Okay, which assets are you going to dip into first? What kind of taxes are you going to pay? Have you set up any type of tax-free retirement plan? Have you done anything along those lines? For instance, one of the big issues and discussions that we have in retirement distribution planning deals with, compound interest versus simple interest. Now, we all know that while you're accumulating assets and you're investing for retirement or you're investing for anything that you want, all of us would prefer for our interest to grow on a compounded basis than on a simple basis. So if you have $100,000 and you're generating 5%, if it's compounded, then on the second year, now you have $105,000 earning 5%. If it's simple interest, then that $100,000 generates 5% or $5,000. And then the next year, the same $100,000 will generate another $5,000 based on the same 5%. So when it comes to accumulating assets, we all want that compounded effect. But then the question that I do ask my clients is, okay, so if you enjoy compound interest so much more than simple interest, would you prefer to have compound tax or simple tax? And then immediately, each and every one of my clients will say to me, no, Bert, I want to have compound interest and simple tax. Well, unless you do economic planning, it doesn't happen in this way. Because if you're putting money into a 401k, and remember, the money you put in is pre-tax, it grows tax deferred, then you pull it out tax-free, that pre-tax contribution that you're making, let's say $10,000, if you happen to be in the 30% tax bracket, $7,000 went to you and $3,000 belongs to the IRS. You just don't know it. But what belongs to the IRS will always belong to the IRS. So the tax on that $10,000 that you put away pre-tax is also compounding. So the key thing is, well, if you do strategic tax planning models and you do tax forwarding planning the way that we do here at Cambridge, using provisional income calculation and so forth, then you actually have the best of both worlds. You do have the ability to create compound interest and also to create a simple tax distribution. And in most cases, we can do away with that simple tax liability and create tax-free retirement income for all of you. Now, understanding the difference, there are different ways that taxes are being generated, and you have your compounding interest, you have the netting, you have flattening, and you have pay down. Obviously, we're not going to get into a discussion of those, but if you don't have a clear understanding between compounding interest, netting the interest, flattening the interest, or paying down the interest, then more than likely you're going to end up paying a lot more money in taxes to the government than you should be paying to them. Unless you're working with an economics advisor or a strategic advisor like the firm that we are here at Cambridge, most of you will never know the importance of adequate compounding strategies in a taxable world. And the other thing that is very critical to understand is what we call velocity of money multiplier effect. And what that means is you want every dollar that you put away to be as efficient as it can possibly be. In other words, if I put money in a 401k, what I'm doing there is I'm creating some retirement for myself. I'm putting money away. The money's growing on a tax-deferred basis and so forth, but it's really not accomplishing many things. When you put money away systematically and strategically into tax-free retirement planning, including the 7702 portion of the IRS code, now $1 that you put away not only will now work more efficiently, but it will protect you in many more different ways, because that $1 not only is the money growing tax deferred and that you can pull tax free, it's also protecting you in case of a need for long-term care. It's also protecting you in case of a premature death. So at the end of the day, I want to make certain that with my investable dollars that I am able to generate the most efficient investment possible with that $1. So if I can get $1 to have a multiplier effect, either on tax benefits or on income benefits, then that's a win-win for me, for myself, for my family, and for my business. Now, once we get into understanding all of these issues and concerns when it comes to retirement, understanding as well how to create a tax-free retirement plan is paramount to having a retirement success. And there are a number of products, actually there are 4 products that by themselves will create tax-free income for you and your family for life. Those are Roth IRAs, Roth 401ks, municipal bonds, and last but not least, tax planning 7702 life insurance contracts. Now, out of the 4 that I just mentioned, there are only 3 that will not have a negative impact on your Social Security distribution. You see, municipal bond funds, although they're received federal income tax-free, they do have a negative impact on Social Security benefits, and it may cause your Social Security benefits to go from 0% in taxes to either 50% or 85% in taxes. So out of the 4 that I mentioned, there are only 3 that do not have a negative impact when it comes to taxation of Social Security benefits. And those are your Roth IRAs, your Roth 401ks, and your 7702 life insurance programs, which are really, really critical from a business perspective. Now, there are primarily 3 basic tax buckets under the IRS code. You have the taxable bucket, you have the tax deferred bucket, and then you have your tax-free bucket. In the taxable bucket, primarily you have your checking and savings accounts, your certificates of deposits or CDs. You have traditional mutual funds and money markets. In the tax deferred buckets, you're going to have your non-qualified annuities. You're going to have your real estate. You're also going to have your traditional pensions, your IRAs, your 401ks, your defined benefit plans if you have one in a company that you work for. You may have what is known as SEP, Simplified Employee Pension, simple plans, deferred compensation, KEOs, 403Bs if you're in the public sector, or if you happen to work in a nonprofit organization. All of those would form part of the tax deferred bucket. The tax-free bucket, primarily there where you're going to have your Roth IRAs, your Roth 401ks, your municipal bonds, and your 7702 tax plans. So that's primarily how the IRS code divides your buckets. And by the way, as an American taxpayer, you decide where the vast majority of your money goes into. Now, taxable buckets, although everything is taxed inside that bucket, it's very important to have, because there you're going to keep your emergency funds. You're going to have liquidity in place for opportunities, and you should not have more than 6 months of expenses and taxes in that bucket. Then once you get into the tax deferred bucket, you're dealing primarily with your qualified plans and your IRAs and 401ks. The amount of assets that you should have in that bucket scenario should not exceed your standard deductions and or other qualified deductions that you would have in retirement. So normally, if I'm dealing with a 50-year-old or a 55-year-old who's going to be retiring in 10 or 15 years, we do net present value calculations to make certain that the amounts of monies that they have in their qualified plans and the amounts that they will continue to contribute to their qualified plans do not exceed the distribution rate or the efficient distribution rate that we want out of these plans in retirement. Because if we exceed those amounts, then we're just increasing our tax liability in many more different ways than you can imagine. The problem is that the vast majority of Americans have never done any type of planning or calculation regarding their qualified plans because they feel that when they put money in a qualified plan, they're saving taxes. No one is saving any taxes in a qualified plan. All you're doing is you're postponing the tax. And when you postpone the tax, guess what? You're also postponing the tax liability. The one question that you need to ask yourselves is, where do you think the taxes are going to be 15, 20, 25, 30 years from now? Because many of us are going to live a long, long life. I would argue, based on the fact that we just hit $21 trillion a week ago on our national debt, our taxes are going to be much, much higher in the future than they are today. The tax-free bucket, anything over the that you have in addition to your taxable bucket and your tax-deferred bucket should go into the tax-free bucket. And it should maximize all of the tax-preferred sections of the IRS code, and the more you maximize those opportunities, the higher your standard of living will be in retirement. Now, for those of you that may or may not know a little bit about Roth accounts, and this would include your IRAs and your 401ks, let me give you a little bit of feedback as to some of the features and benefits that they do possess. In a Roth account, the money grows on a tax-free basis. Obviously, when you put the money in the account, you have already paid taxes. So the money grows tax deferred, and then when you pull it out, is tax-free. So in reality, if you own a wheat farm, the question is, well, would you rather pay taxes on the seeds, or do you want to pay taxes on the harvest? I would argue that if I'm a farmer, I would rather pay taxes on the seeds or on a few bushels of seeds as opposed to truckloads of harvest in the fall. So this is a reason why I love the Roth IRA and Roth 401k type plans. Now, there are limited contributions to these plans. Roth IRAs have a more challenging contribution level than Roth 401ks. In 2018, for a Roth IRA is $5,500, for a Roth 401k is $18,500. And the other limitation is that there is no access to the accumulated funds prior to age 59 and a half, unless there are some exigent circumstances, death, disability, and so forth. Now, one of the benefits of Roth accounts is that they don't have a required minimum distribution of funds at age 70 and a half. As you know, in traditional qualified plans, you need to start taking distribution at age 70 and a half, whether you want to or not. And if you don't take the distribution at age 70 and a half, guess what's going to happen? You're going to have to pay federal income taxes on the amount of money that you should have distributed out of the qualified plan that you didn't do in that year. Plus, you're going to have to pay a 50% penalty on that distribution as well. Yes, you heard me right, a 50% penalty. So it is very critical to understand that you have to know the rules of engagement so you can play the game in order to win. Now, no Social Security tax triggers, and that's a good thing because I want to make certain that all of my clients receive their Social Security benefits tax-free if at all possible. And it is creditor protected, so if you get sued, no one is going to be able to take your money away. Now, when it comes to municipal bond funds, again, the money that you invest your muni bonds in, you already pay taxes on that money, but the money grows tax deferred, and you pull all that growth tax free. There's also tax-free distribution in your residential state, so that's important to note. And you do have access to your funds prior to age 59 and a half, so you have more liquidity than you would in a traditional Roth IRA or Roth 401k. There is no minimum required distribution at age 70 and a half, so pretty much municipal bonds are very, very liquid from that perspective. They do, though, provide a Social Security tax trigger based on your provisional income calculation, depending on the level that income may be. So that could have a negative effect on your Social Security benefits, and there's no credit protection for municipal bonds. Now, when we get into the 7702 tax plan under the IRS code, which includes life insurance, here are some of the critical benefits that I think are very, very important. Every single retirement plan should have at the core a properly structured life insurance program. Number one, it provides a tax-free death benefit at the time that the family and the person needs it most. So think of the death benefit portion of this type of 7702 contract to be money in escrow. And escrow closes the day someone dies. So when you need cash, it will be readily available on a tax-free basis. Number two, the money after you pay taxes for your contributions, the money grows tax deferred. And you also have tax-free distribution of that growth as long as you do it the right way. So it does give you that tremendous feature. You also have a tax-free transfer of your funds and death benefit, with the proper structure and so forth. You do have a lot of liquidity similar to what you had in municipal bonds because you have access to your funds prior to age 59 and a half, no taxes and no penalties. So if you have a lot of money in these plans, and many of my clients have a lot of money in these plans, they do have the ability to put money away and use it not only for emergencies but also for business opportunities like real estate and so forth. Again, there's no required minimum distribution at age 70 and a half, so you have no penalties if you pull the money out prior to 59 and a half. The money grows tax deferred. You can use it for whatever you want. If you happen to have a premature death, the death benefit is totally tax free. There's no required minimum distribution, so you can start to invade your traditional 401ks and IRAs at age 70 and a half because you have no choice, but you can allow your Roth accounts, your municipal bonds, and your 7702 plans, tax plans, to continue to grow until such time in the future that you may want to start to invade them. In most states, I live in the state of Florida, tax plans under 7702 are creditor protected. They're also, in many ways, and this is not something that any of the other products that I have just talked about enjoy, they're self-completed in case of death or disability if you structure them properly. They also provide something that's going to be very critical for all of us on this podcast. They do provide for long-term care benefits. You see, in the old days, you could have purchased a long-term care policy and everything is good. So you're 50 years old, you purchase a life insurance policy. If you died in your sleep at age 85, all that premium that you put into that long-term care contract is pretty much gone. It's just like, purchasing auto insurance, and if you don't have an accident at the end of the year, well, you have to renew it the following year, as there are no benefits and there are no gains. Now, obviously, if you had a need for long-term care, those products work very well. With the new type of 7702 tax plans that we put together for our clients as part of a sound and economic retirement blueprint, we want to make certain that we have some long-term care features and benefits inside of these contracts. And the new contracts are available in the marketplace and do provide for those. So we have chronic illness riders, we have critical illness riders, and then we also have long-term care riders. So these contracts can satisfy a multitude of benefits, provide a multitude of benefits, but also solve a multitude of problems that may occur in the future, and knowing that someone will always get the benefit. So if you have to have long-term care and you have $1 million contract, you can start taking money out of your death benefit in order to cover your long-term care expenses. And then once you pass away, whatever remains in that contract will continue to go to your surviving beneficiary on a tax-free basis as well, and so forth. So that's very critical. The other thing that it does is when we do this type of planning, we also use 7702 tax planning plans to provide Social Security planning. And the reason why I say that is that if you're married and you're both in retirement, one of the benefits that the Social Security Administration gives you is that if one of you were to die prematurely, the surviving spouse would take the higher of the two benefits. So if the spouse's benefit was higher, then he or she would assume that benefit and move forward. The problem with that is that when you assume that one benefit, the other benefit is gone. And most American families get used to living on two Social Security benefits, and regardless of whether you're able to assume the higher one or not, the fact remains that one of those benefits is going to go away, and who's going to cover the difference for that? And that's where Social Security planning comes into play, using 7702 tax plans, which are very critical for all of us to understand. Now, whenever we do these type of plans for our clients, we pay a lot of attention to making certain that we maximize the internal return on these plans. So on 7702 plans, the insurance companies determine the minimum amount of contribution, and then the Internal Revenue Code determines the maximum amount of contribution. We at Cambridge determine the optimum amount of contribution. So you have what the minimum is required by the insurance carrier, what the maximum is required by the IRS code, and then what the optimum is required based on the goals and objectives that we want to do with our clients. Now, we work with a lot of wealthy clients, so many a times they do have disposable income. So let's say a 45-year-old that wants to acquire $1 million death benefit in order to protect the family from a premature death and long-term care, critical illness, and chronic illness issues and concerns. The insurance company may only require a contribution of $1,345 to that plan. The IRS will say, well, the maximum that I, as the IRS, will allow you to put into this plan will be $56,571. So between $1,345 and $56,571, the client can determine whatever it is they want to do. Again, when driving the optimum contribution, we at Cambridge try to get as close as we possibly can, if assets permit, to that 56,571, because now that's money that's growing on a tax-preferred basis. It's actually accelerating the growth. We can access the money on a tax-free basis prior to age 59 and a half, from 59 and a half to 70 and a half, and then we don't have to have access to that money at 70 and a half unless we really need to do so. So again, these benefits of using a combination or straddles of Roth IRAs, Roth 401ks, to a certain extent, municipal bonds, as long as they don't have a negative impact on Social Security distribution, and 7702 tax plans allow us to really provide what I call protected risks. When you have a 7702 plan as the core, as the center of your retirement universe, you're able to protect with $1, one single dollar of contribution, the protection against premature death, protection against living too long, because you're able now to start spending down principal and interest at the same time without having to run out of money before you run out of life. It also provides protection against disability and long-term care. It also helps our clients minimize their eroding factors because of the tax benefits and the fact that because you do have the luxury to dip into principal, you're able to offset inflation in the future. And then, last but not least, the enormous tax benefits that it does provide. So again, these are things that we discuss and plan with our clients, because we feel very strongly that the more education that we give all of you, the better off we're all going to be. Because at the end of the day, information without education always leads to failure. And our motto at Cambridge, my motto is that my number one goal in my financial life and helping clients is I want to help each and every one of you to change the way that you see things. Because when you do change the way that you see things, the things that you see change. So again, thank you so much for joining us today for this webinar, and we'll talk again soon next week.